Thank you.
Yeah, thank you. All right. You're gonna be standing right there?
Yeah.
Okay. Okay.
Okay. All right. So what I wanted to talk to you guys about today, or some of the things that I was thinking about as we've gotten some of your files in processing, and some of you guys are newer, but the things that I'm seeing wrong with files is about half of them are structure problems, and structure on a mortgage loan is a loan officer's job. You set the structure, right? So if you have, let's think of somebody building a house, and someone comes in and lays down the foundation, and then the rest is like put up the framing and doing all the little tasks outside of that. But that foundation is the most important part, okay? And that's the loan officer's job, and LOA, where you help give support in those areas. So the structure is really a understanding of risk. When you're trying to structure a home loan, it's an understanding of how to assess risk. Okay, and if you can understand how to assess risk, then you know how to structure. You know how to structure a loan. Okay, so I like to draw. I have a chart that I sometimes draw, and it's how I look at a loan. So I draw a T-chart and I look at it as if you have a plus over here, minus over here. And really this is how I look at like at different parts of a loan. You know, so if you have good credit, that's a plus. Bad credit or marginal credit or thin credit, that's a minus, right? Own funds for down payment would be a plus. A gift?
Minus.
Okay. Now, are these two things are never good to have together. This is credit. Right? You never want to have these two things together on the same side on the loan. That's a poorly structured loan. When credit is on this side, you don't want to have anything else on this side of the chart. You want everything else to be a plus. Okay? And that's how you need to perceive the file. What else is there? If the payment shock, the proposed housing payment versus the current housing. Is 0, and then the payment goes to 2,000. Well, 2,000. That's a negative, right? Okay. This person's been on the job for 2+ years, and this person has changed job every 3 months. Has changed job. That's a negative, right? And so when you're taking an application on the phone, these are the things you're thinking about. How many negatives do I have, and how many positives? And if somebody has bad credit or poor credit, you never want to allow them to bring any other negative factors in. And the reason why is if you take this, you take mortgage banking into simpler terms, like just a friend or two people lending money to each other, right? Like Nick lending money to Priscilla. Just the two of you. Forget about all the processing of loans and all that other crap. And you just think about it as two people. And he has a lot of money. He wants money, right? And so he goes. They don't know each other, but Priscilla goes to Nick and says, "Hey, man, I need $5,000 or whatever." Nick says, "Well, how do I know you're going to repay this money?" Then he goes, "Well, I work over here at this place. I work for my dad, right?" So in Nick's mind, it's like he works for his dad. So to me, it's like I don't know if I could really believe a lot of what he's going to tell me as far as what he's getting paid, right? So the next thing it says, what references do you have? And all the references that Priscilla provides are all family members. So Nick is evaluating this situation and said, so far, I see this as a very risky transaction, right? Do you understand? Mm-hmm. Okay. Because everything that Priscilla is providing to him, the validity of these references, it could easily be manipulated. Okay, the validity of the employment. Could be easily manipulated. So now everything's starting to mount up on this in his mind. In Nick's mind, everything is starting to stack up on this side of the chart. And the feeling that Nick has in his gut is a negative feeling. Okay? And that negative feeling is telling him not to lend Brasiliano $5,000. Right? So this is the same experience that happens right now when we deal with submitting a loan to underwrite, which you guys don't, you may not realize because of all the steps involved. But it's that simple. When an underwriter reviews the loan, if you have too many things stacked up on this side, they're going to say no. Right? So you have the ability to design this from the beginning if you get it at the right time. Okay, which is at the time that you're talking to the person that you're taking their application. It's not time to do it, when they're already in contract, to figure out how to restructure these things, how to take a negative and move it into a positive. Okay, because you put the company at risk. But the underwriter's comfort level, just like the feeling that Nick was experiencing whether or not to lend him money, right? That's what the underwriter is going to feel when they're looking over a file. Because they're looking at these risk factors, the negative risk factors and the positive, and trying to determine their comfort level with it. If they're comfortable with lending this person the money. So let's take Steven as another. You're going to lend money. Another person comes to you. Here comes Steven. Now Steven comes to you and says, you ask him, he wants $5,000 due, and you ask him who he works for. And he works for a big corporation, and he shows you his pay stubs, and he's getting a salary. So you're like, hey, this is pretty legit, right? Okay. Then you ask him for references. He supplies you with references that all of them are non-family. He gives you like 3 references that probably last about 24 months each. How do you feel about that?
I feel more comfortable.
Why?
I mean, he's a large corporation, secured in his job. I would feel like he would be working there for a long time versus job hopping and stuff. I would feel a little more secure. More secure
lending him money?
Yeah.
Okay. That's the key to designing a home loan, structuring a loan. Is if you can control that feeling. Okay, that feeling that you're passing on to the underwriter. Okay? The one that makes the decision of whether or not to grant credit. And that's what we try to take in consideration, or at least I do in the process. And some of you guys that are newer, you probably think, okay, I got a good credit score, or I'm getting docs in, and there's a lot of stuff you're trying to understand. But if you just try to break it down to something as simple as that type of relationship from one person to another person, lending someone money, and that comfort level, you see what I'm saying? It really boils down to that. Does that make sense? Mm-hmm. Now, has anyone ever considered anything like that when they're talking to a borrower? And taking anything as far as, these things in consideration? The risk, this person being risky on some level? You have? Okay. Can you give me an example?
Well, one of the first ones I had was a lady who wanted to refinance her house and get cash out, but she didn't really have a house payment that was like $200 a month, and the refinance was going to take her up to like $700-800 a month. And then also, and that's just kind of understanding what she really want to do. That's coming from a background when I did insurances. I can say this is what you need. But if it affects your budget to where it's a shop where you used to spend $10 a month, and I'm taking you up to $100 a month, mentally, most people can't correlate that thing. It's always about, so I kind of connect that to whether it's $100 a month, or we're talking about $200,000 loans, the bigger the loan amount, the bigger the risk. And
right.
So if somebody's staying rent-free at their home, you can't go from staying with your parents to spending $1,500.
It depends. It depends on how that mounts up here. Right. So if that's the only negative, and you have, the guy has money in the bank, we got reserves. Okay, that's a positive. Right? He's got reserves. He's a college graduate. He's working for a large corporation. He's got several trade lines. Taking it from 0 to 2,000, not that big of a deal. The one that is the biggest concern is credit. That's the biggest concern. And that's where we're seeing, I'll show you a few examples, but that's where we're seeing the most problem is in credit, reviewing credit and assets. Okay, that's the biggest hurdles we have right now. Is properly structuring a loan with bad credit with too many other negative risk factors with gift funds. Okay, I got a loan that, just to give you an example, I got a loan in processing right now that I rejected a month ago. Okay, pending contract, supposed to close in 2 weeks, and the borrower's credit score is like a 610, and really marginal credit. I'm going to show you the credit so you can see. Okay. But the borrower didn't really know where they were going to get the money for the down payment, so that's why it's been taking so long. So the loan was rejected from processing for several reasons, but that being one of them. It ended up being that the borrower went ahead and got a gift, okay? And that gift raised a concern, and added a negative on this side of the chart, right? And this is how DU interprets things, which is our automated underwriting engine. So we ran the loan through DU with a gift, and the guy's borrowed for credit, and it gave us a different result. And it just gave us a referral. It says, no, you know what? No. But if the guy had his own money in the bank, he said, yeah, we'll take it. He's like approved eligible, but we wanted 3 months reserves with his own money. Now they added a gift to it, and it took the reserves up to 4 months reserves required to get an approved eligible in DU. Now what that means is that the guy still doesn't have it together. Okay, and this is a concern, and that's one of the things why we're addressing this. But what should have been done is this should have been addressed at the time the guy was pre-qualified. We should have gone over assets with the guy at the time that he was pre-qualified. Where's the money going to come from for down payment or for closing? What's the plan? But the thing is that this loan is drugged through the mud, right? And the guy's in contract. I'm supposed to have a call with the agent today to try and get an extension, if they're have mercy to allow that, right? It ends up being putting everyone in a scary position that they don't have to be in. So when you're on the phone taking an application, you want to look at risk, okay? Different key points, and so reserves, no reserves, own funds versus gift funds. What else do I got on here? Rental history. Rental history is important. Rental history is over here.
The ratios too, right? If the ratios are low,
Okay.
they're tight.
Ratios.
We gotta specify rental history, the way that's verified too.
Let's go declining income, inclining. What else? You said ratios? Okay, low ratios. But anyway, everything has its balance. And this is simple, but so happens over time that people don't, they're caught up in just getting a loan in that they don't take the time to remember how simple this is. Okay? Anything else as far as risk factors?
Yeah, the Emerson file that we were working on, her husband had died, and so half of the royalties went down from 2014 to 2015. It would be considered declining income, but it's not necessarily.
That's not in that case. Not really in that case.
Really?
It's more like
Okay.
that's not really, because there's an explanation.
Yeah.
So that kind of neutralizes it.
Alright.
Yeah.
Well, because your credit's good and everything else is good.
Property type, mobile home, or regular house. That is. Why? How hard was it to close your mobile home deal? How much time did how many months was it in here for?
When I first started, like March.
Okay.
Literally is when I started talking to him. Then we had to switch it after it got.
It was probably possible for like 3 or 4 months.
Yeah.
It was a $130,000 deal. It wasn't worth the time, but anyway. this, you know, the process that we go through for this type of, you know, this type of deal, a mobile home, is extensive, and it's because of the risk of the property. And we send it out to another company to do because we as a bank don't want to take that risk. This is too much risk for the reward. Okay? Alright. Let's see what else I got as far as risk goes.
Unemployment is a bad, right? Unemployment. Gaps in employment.
Gaps?
Gaps in employment.
Yeah. But it's, I mean, you could add probably a couple more things to this, but the core things is going to be, you know, the credit, where they're getting the money from, how long they've been on the job, how long they've been living where they're at the residence. You're looking to identify stability. Okay? So, that's it on this risk assessment. I want to show you guys some credit reports so you can kind of see what I'm talking about as far as this goes. Some of these key items that we want to break down into simpler terms where you can understand and can actually see it. Okay? Is this good? Okay. Good. Okay. All right, go out here.